So what constitutes a bear market? It's typically when stocks are down 20% or more for about 2 consecutive months or so. That's typically when people consider it a bear market. Typically what investors do is they look at the S&P 500 as the benchmark for this, and when they see the S&P 500 is down 50% or more from its highs, they say we have entered a bear market, or we're entering bear market territory. So a recent example of this was back in December 2018, just a few months ago. You notice we had a pretty big sell-off in the stock market, and we actually technically entered bear market territory there because we did have a dip of over 20%, but it was extremely brief and the bull stepped back in, and just a few months later we're back at all-time highs. So in that situation there, we entered bear market territory, but we weren't really in a bear market. But what if I told you that right now, as we speak, we're actually in a bear market and investors just don't realize it? So if we look at the S&P 500 chart right now, you can see that we're down maybe around 6% or so from all-time highs. And you're probably thinking, didn't I just say that we're only in a bear market if we're down over 20%? So shouldn't it be down over 20% if I'm claiming that we're in a bear market right now? Well, you're absolutely correct technically, but let me show you the details behind this as to why I believe we're actually in kind of like a stealth bear market. So what's going on right now is actually a few big stocks out there are helping keep up the stock market near its all-time highs. Although the S&P 500, for example, is made up of around 505 different companies, there's a handful of them that play a major role in keeping the stock market as to where it is today, because not all the stocks in there are equally weighted. So the larger the market cap of a company is, the more role it plays in the whole weighting of the S&P 500. Now, some people might argue and say, well, this is how it should be because these are the largest companies in America, and as a result, they play the largest role in our economy, so they should be the most weighted. Some might argue that, we have a lot of other companies there. Just because some of these massive giants are as big as they are does not mean that they should be higher weighted than companies that are smaller but are still doing great things in our economy. Well, whatever the case is, it is how it is, and that's how the market is set up today. So, the larger the company is, the more weight it has on the index. So now let's look at the actual breakdown of the S&P 500 and the weightings behind it. So a little over 20% of the overall market is determined by the top 15 stocks that you see here on your screen out of the some odd 505 stocks in the S&P 500. Now, Microsoft, Apple, Facebook, Amazon, and Google, just these 5 alone make up 16% of the overall market here. And that is, again, 5 out of 505 different stocks. In other words, less than 1%, about 0.99% of the stocks in the S&P 500 determines 16% of its value today. And this is why I think that the S&P 500 is actually artificially up, and in reality, we are actually in a bear market already. To prove this, let's take a look at some large companies out there that are not these large tech giants and see where they are right now compared to their all-time highs. Nvidia, which is about a $100 billion company, is down around 50% from its all-time highs. AbbVie, another huge popular stock in the dividend community, another close to $100 billion company, is down around 50% from its all-time highs. Altria, another massive stock, $90 billion company, down 41% from its all-time highs. 3M, another huge industrial company, another close to $100 billion, down around 38% from its all-time highs. And then you get into companies that are in the $50 to $100 billion range, like Goldman Sachs, down around 30%. Caterpillar, down around 33%. Boeing, this one's actually close to $200 billion and it's down around 27% from its all-time highs. And then if you look at smaller companies in the S&P 500, say under $50 billion or so, the list goes on and on of how significant these crashes are in these stocks. iRobot is down 52%, Align Technology is down 56%, Square down 40%, FedEx down around 45%, and the list goes on and on. And many other stocks, if they're not down this significantly, are still down from their all-time highs over 20% or so. And a recent example of this is Pfizer, which is another massive Goliath company that's down close to 25% from its all-time highs. So stock after stock, we're seeing some double-digit corrections here, and a lot of them are down over 50% from their all-time highs, meaning that these stocks have lost 50% of their value in a short period of time, really. Now, looking at this data that I just provided you, how can you look at me and tell me that we're not in a bear market? Just because a handful of stocks are holding the market up artificially near its all-time highs does not mean that the 450 plus other companies should be ignored just because they're smaller companies. Now, apart from the 15 that I actually showed you earlier, there are other companies also that are fairly large that are keeping the market fairly up and sustained right now. Companies like McDonald's, Pepsi, Coca-Cola, Disney. These are other large giant companies that are helping contribute to those high levels in the S&P 500. But again, these make up a very small portion as to where the overall stock market, the overall stocks are right now. And also what I found interesting is that these companies like Pepsi, McDonald's and stuff are companies that people actually flood to during recessions or times of uncertainty or economic downturn possibilities. So it's interesting to see that these stocks are actually making new all-time highs or close to their all-time highs when the market is showing signs of a weakness here. Another piece of data that I like to look at is to see how many stocks are above or below their 200 moving average. The 200 moving average is usually seen as very strong support for stocks, and typically when they break below this, it's seen as a very bearish sign. Also, typically when stocks are close to the 200 moving average or around it, kind of below it, slightly above it, they're typically down significantly from their all-time highs, which is another bearish signal. So looking at the data here from FinWiz, we can see that the overall market, including the New York Stock Exchange, NASDAQ, and the Amex exchange, shows that around 42% of stocks are above the 200 moving average, and around 58% of them are below. This means that the majority of stocks are actually showing us bearish signals here that their charts are looking weak. And if you look at the 50 moving average, which is another indicator that I look at, but it's not as significant as the 200 moving average, this number gets even more staggering, with only 28.5% above and 71.5% below this line. And what this really tells us is that out of the 42% of stocks that are above the 200 moving average right now, 71.5% of them are actually below their 50 moving average and could be heading closer to the 200 moving average, which is another sign of bearish sentiment. So guys, looking at the data here, without fluffing anything, without beating around the bush, I think it's pretty clear that we're close to a bear market, if not already in a bear market, with majority of stocks out there. But until we see these large tech giants like Apple, Amazon, Facebook, Google, Microsoft start to correct and start to show signs of weakness, the S&P 500 may still stay at these high artificial levels, showing investors from a high level that things are fine and there's nothing to worry about. But regardless of what it is, if you're proactive and you actually look at the insight and the information here, you'll actually be ahead of the curve compared to the average investor who just looks at the headlines, who just looks at the S&P 500, sees that it's up near its all-time highs and just says everything's good. Now, this does not mean that I'm telling you to sell all your stocks or try to time the market, because that, of course, never works and wouldn't make sense for a long-term investor. But all I'm saying is that you should be cautious, and having cash on the sidelines here at this time is not a bad idea. What I'm personally doing is I continue to buy these oversold companies that are still massive companies, have strong futures, but are down maybe 40, 50% from their all-time highs currently. I'm not buying stocks like Amazon, Google, Microsoft, Apple, Facebook right now at these levels, because again, they're pretty close to the all-time highs, and I don't believe we're getting value in these stocks right now. But I think that when these stocks do start to correct, we're going to see something very similar to what we saw in December, because back in December, these stocks actually took a 20 to 30% correction. And when that happened, you saw how quickly the stock market dropped day after day, and there was just panic everywhere. People were selling their positions, and that's exactly when I want to step in and buy some shares of these massive companies. Holding cash right now will actually set you up in a position to take advantage of that possibility if it does happen. And if it doesn't, well, it's still always good to hold cash in your account, just because stocks do go on sale occasionally, and when they do, that's when you want to deploy your capital to maximize on your future gains. Remember, just because the S&P 500 is down around 6% from its all-time highs today does not mean that you cannot find deals out there in the market. Look for deals, spend your cash wisely, and keep a good cash reserve in your account, because when the S&P 500 does finally correct 20% or more, we will see some incredible deals on these massive tech giants, and that's exactly when I'm going to be pouncing on those companies, as well as many other great companies in the market as well. Hope you guys enjoyed this video, hope you learned something from this video, and I hope this gave you some insight as to what's going on behind the scenes of the market, and you shouldn't just take things for face value. Don't forget to invest positively, guys, and drop a huge like if you learned something here. But either way, I'll see you in the next one. Peace.